Silver has a habit of humiliating consensus because it never moves when people feel ready and it never breaks when confidence is high. Instead, it waits until positioning is wrong, liquidity is thin, and complacency is universal. And then it moves with a violence that rewrites charts in hours rather than years. And what makes the current moment uniquely dangerous and uniquely powerful is not a single headline, not a CPI print, not a Fed speech, but the convergence of structural pressure, points that only appear together at the very end of long suppression cycles. Because silver is not merely a commodity, but a hybrid system trapped between monetary history and industrial necessity, priced in a paper market that has expanded far beyond the physical reality it claims to represent. And for years, that system has survived not because it is sound, but because confidence has been continuous, leverage has been cheap, and delivery has been avoided. Yet those conditions are now eroding simultaneously as physical inventories continue to drain from global exchanges. Industrial demand accelerates from solar, electrification, defense, and AI infrastructure. Mining supply remains constrained after a decade of underinvestment, and paper positioning remains historically stretched, creating a structure where price stability is no longer a sign of balance, but a sign of stored tension, because when an asset refuses to fall despite negative sentiment, rising rates, and aggressive paper selling, it is not weak, it is coiled. And silver today is more coiled than at any point since the breakdowns that preceded its most explosive rallies in modern history, including 1979, 2011, and the post-2020 liquidity shock, all of which shared the same invisible precursor, a moment where liquidity vanished faster than sellers expected, forcing repricing not through opinion but through necessity. And this is why the phrase "within hours" is not exaggeration but historical accuracy, because silver does not need a mass of buyers to move, it only needs sellers to disappear. And in a market dominated by futures, options, and leveraged positioning, that disappearance can occur instantly when margin stress rises, funding tightens, or volatility spikes elsewhere in the system, forcing traders to cover, roll, or exit simultaneously. And right now, the macro environment is primed for exactly that kind of cascade. Because global liquidity is fragmenting rather than expanding, the US dollar remains structurally strong not due to health, but due to shortage. Funding markets are showing stress beneath the surface, and confidence in financial intermediaries is weaker than price charts suggest, meaning silver is sitting at the intersection of three forces that historically do not coexist for long without rupture: constrained physical supply, rising real-world demand, and overextended paper control. And to understand why this matters, you must understand how silver is actually priced. Because unlike equities or bonds, silver's price is not discovered primarily through physical exchange, but through derivatives that reference physical availability without requiring immediate delivery, creating a system where price can be suppressed as long as most participants accept cash settlement rather than metal. But the moment that assumption shifts, even marginally, price must rise aggressively to ration limited supply. And this is why silver rallies feel irrational to those watching from the outside, because they are not driven by new information, but by the sudden realization that old assumptions no longer hold. And today those assumptions are cracking as more participants question counterparty risk, settlement risk, and the reliability of paper claims in a world where trust is being replaced by collateral. And this shift is subtle until it is not, because markets do not transition smoothly from confidence to fear, they flip, and silver is one of the few markets where that flip is amplified rather than absorbed, due to its relatively small size, thin liquidity, and asymmetric positioning, meaning a relatively small flow of capital can cause disproportionate price movement when it arrives at the wrong moment. And that moment is approaching because the broader system is under strain from rising debt servicing costs, declining real growth, and a monetary regime that requires continuous intervention to prevent instability. Yet every intervention distorts price signals further, increasing the eventual correction. And silver thrives in exactly this environment, not because it is hyped, but because it exposes contradiction, the contradiction between fiat expansion and real scarcity, between digital claims and physical limits, and between short-term control and long-term reality. And this is why silver often lags gold initially and then violently outperforms. Because gold is held as reserve while silver is consumed. And once consumption collides with investment demand, the system has no buffer, no strategic stockpile, and no quick supply response, forcing price to do the work. And what makes the present setup even more explosive is that sentiment remains skeptical, positioning is cautious, and mainstream narratives dismiss silver as boring, volatile, or manipulated, which is precisely the psychological environment that precedes breakout rather than exhaustion. Because markets do not top on disbelief, they bottom on it. And silver has spent years training participants to expect disappointment, conditioning them to sell rallies and fade strength, which is why when the real move begins, it traps both sides simultaneously. Shorts are forced to cover into rising prices while sidelined capital chases confirmation that never arrives. And this is how silver turns hours into history, not gradually, not politely, but through repricing events that feel unfair only because they expose how artificial the previous price was. And none of this requires a global crisis announcement, a war escalation, or a policy shock. It only requires a modest disruption in liquidity, settlement, or confidence to expose a market that has been stretched far beyond equilibrium. And once that exposure occurs, the move does not wait for consensus. It bypasses it. Because silver does not surge when everyone agrees. It surges when the system can no longer pretend. Why silver explodes without warning. Paper control versus physical reality. To understand why silver surges do not announce themselves politely and why they so often appear to come out of nowhere, you have to abandon the idea that markets move because of news and instead understand that markets move because of positioning, liquidity, and constraint. And silver is one of the clearest examples of this truth, because its price is not the result of balanced supply and demand, but of a prolonged structural imbalance between paper claims and physical metal that only remains stable as long as confidence holds. And the moment confidence weakens even slightly, the repricing is sudden, nonlinear, and violent, because paper markets can expand infinitely while physical markets cannot. And silver sits at the fault line between these two realities, where decades of financial engineering have allowed institutions to sell future promises of silver far, in excess of what actually exists above ground in deliverable form, creating a system that appears liquid and stable until participants demand the one thing it cannot provide at scale: immediate physical settlement. And history shows repeatedly that when this demand emerges, price does not adjust gradually, it gaps, because there is no marginal supply waiting to meet it. And this is why silver's largest moves always occur during periods of confusion rather than clarity. When liquidity is thin, volatility is rising elsewhere, and risk managers are forcing desks to reduce exposure simultaneously, triggering a chain reaction where shorts rush to exit, longs refuse to sell, and algorithms amplify momentum faster than human judgment can respond. And this pattern has repeated with such consistency that it is almost mechanical, yet it continues to surprise because it violates the intuitive belief that markets move proportionally to information, when in reality they move proportionally to stress, and stress accumulates invisibly until it is released. And nowhere is that release more dramatic than in a market as small, leveraged, and strategically important as silver, because unlike gold, which is hoarded and slowly accumulated by central banks, silver is consumed irreversibly by industry, disappearing into electronics, solar panels, medical equipment, defense systems, and data infrastructure, meaning that every ounce used is an ounce that cannot return to the market without cost, energy, and time. Yet the paper market treats silver as if it were endlessly recyclable and always available, pricing it as though inventory were infinite rather than finite. And this disconnect grows more dangerous with each passing year because mining supply has failed to respond to rising demand due to declining ore grades, environmental constraints, capital discipline, and the fact that most silver is produced as a byproduct of other metals, meaning its supply cannot be easily ramped even if price rises, creating a structural lag that paper markets ignore but physical markets cannot. And this is why silver squeezes are not speculative fantasies, but mechanical outcomes of mispricing. Because when demand accelerates into a constrained system, price must rise, not to attract new supply, but to ration existing supply. And rationing is never gentle, especially when inventories are already tight and logistics are strained. And this is exactly the environment forming now as exchange stocks decline. Premiums rise quietly in physical markets, delivery times extend, and large buyers shift from spot purchases to long-term contracts to secure metal before it becomes unavailable, all while futures prices remain subdued due to concentrated short positioning that suppresses volatility until it can no longer do so. And the reason this suppression persists is not because shorts are confident, but because they are large, coordinated, and accustomed to a system that has always bailed them out through liquidity injections, rollovers, and cash settlement. Yet this confidence is dangerous because it assumes continuity, and continuity is precisely what breaks at turning points. Because at some moment, the cost of maintaining control exceeds the benefit, and the trade flips from profitable to existential, forcing rapid exit rather than gradual adjustment. And when that happens in silver, the exit is not orderly because there is no depth on the other side, no large pool of willing sellers, only reluctant holders who have waited years for repricing and are not inclined to sell at the first sign of strength. And this creates a vacuum where price must jump to find equilibrium, often overshooting, because algorithms and momentum traders pile in once resistance breaks, turning what began as a positioning adjustment into a narrative event after the fact, with media scrambling to explain a move that had no single cause but many cumulative ones. And this is why silver's biggest rallies are always explained backward, attributed to inflation, currency weakness, geopolitics, or retail enthusiasm, when in reality those factors were present long before price moved. And what changed was not information, but fragility. The fragility of a system stretched too far by leverage and complacency, and today that fragility is evident in subtle ways that most participants overlook, such as the increasing correlation between silver and funding stress, the sensitivity of price to small volume spikes, the repeated failure of price to stay suppressed despite aggressive selling, and the growing divergence between physical demand indicators and futures sentiment, all of which suggest that control is weakening rather than strengthening. And when control weakens in leveraged markets, it does not fade, it snaps, because leverage amplifies error, and the longer suppression continues, the more violent the release. Which is why the phrase within hours is not marketing but mechanism, because once a threshold is crossed, whether through a margin call cascade, a delivery squeeze, a volatility spike in another asset class, or a sudden rush for safe collateral, the move accelerates faster than discretionary traders can respond, turning disbelief into panic in real time. And this is the stage silver appears to be approaching now, not because everyone is bullish, but because the system is brittle, and brittle systems do not need a large shock to fail, only the triggers that ignite silver. Within hours, liquidity, margin, and forced action. If silver truly is approaching a moment where price can explode within hours rather than weeks or months, then the only way to understand how that happens is to examine the exact triggers that convert hidden stress into visible price action. Because markets do not move when people agree. They move when people are forced, and forced behavior is always driven by constraints, not opinions. And in silver, those constraints are overwhelmingly tied to liquidity, margin, and funding mechanics that operate beneath the surface of charts and headlines, invisible to most investors, until they suddenly dominate everything. Because silver is not just a commodity, it is a leveraged financial instrument traded inside a system that assumes constant access to cheap credit, stable collateral values, and predictable volatility. And the moment any of those assumptions break, silver stops behaving like a metal and starts behaving like a pressure valve, releasing accumulated stress faster than participants expect. And the first and most powerful trigger in this process is liquidity shock, because liquidity is the oxygen of leveraged markets. And when it thins even slightly, positions that appeared safe become unstable, bid, ask spreads widen, slippage increases, and traders who rely on tight execution discover that exits no longer exist at theoretical prices, forcing them to act faster and more aggressively than planned, and liquidity shocks rarely originate inside the silver market itself. Instead, they spill over from elsewhere, such as sudden volatility in equities, a spike in bond yields, stress in funding markets, or unexpected moves in currencies, all of which compel risk managers to reduce exposure across portfolios simultaneously. And because silver is relatively small compared to equities or sovereign bonds, even modest reallocations can overwhelm its depth, turning routine de-risking into price acceleration. And this is compounded by the fact that many silver shorts are not directional bets, but hedges embedded within larger strategies, meaning they are often the first positions to be closed when capital is needed elsewhere. Because closing a short frees margin immediately, and this behavior is not discretionary but procedural, coded into risk systems that do not debate narratives. They enforce thresholds. And when those thresholds are crossed, selling or covering happens automatically, regardless of conviction. And this is where margin calls become the second critical trigger, because margin is the glue holding leveraged positions together. And when volatility rises or collateral values fall, margin requirements increase precisely when liquidity is deteriorating, creating a feedback loop where participants must post more cash into a system that has less of it. And silver's volatility profile makes it especially sensitive to this dynamic, because even small price moves can dramatically change margin requirements, forcing traders to either inject capital or reduce exposure. And in stressed environments, capital is scarce, so exposure is reduced. And reduction in a short position means buying, not selling, which pushes price higher, increasing volatility further, raising margin again, and accelerating the cycle. And this is why silver rallies often appear self-reinforcing once they begin, because the same mechanics that suppressed price for years suddenly operate in reverse, turning hedges into liabilities and risk controls into accelerants. And the third trigger, closely related but distinct, is funding stress, particularly in short-term markets like repo, where institutions finance their positions overnight using collateral. Because silver trading desks do not operate in isolation, they are part of balance sheets that rely on continuous access to funding. And when funding costs rise or availability tightens, the cost of carrying positions increases, making strategies that were profitable under cheap funding suddenly unviable. And history shows that spikes in repo rates, widening swap spreads, or sudden demand for cash often precede sharp moves in precious metals, not because metals cause stress, but because they reveal it. As desks scramble to free up liquidity by closing positions that consume margin or capital, and silver, due to its leverage and volatility, is often at the top of that list. And this is why events that seem unrelated to silver, such as a treasury auction failure, a banking sector wobble, or a currency intervention, can trigger silver moves within hours because they alter the funding environment instantly, leaving no time for gradual adjustment. And another underestimated trigger is delivery stress, which occurs when futures markets approach settlement periods with elevated open interest relative to available deliverable supply. Because while most contracts are rolled or cash settled, the system relies on the assumption that enough participants are willing to accept paper instead of metal. And when that assumption weakens, whether due to geopolitical uncertainty, supply disruptions, or rising physical demand, the threat of delivery forces shorts to reduce exposure preemptively, not because they expect default, but because they cannot risk being the marginal player when others demand metal, and this behavior is subtle but powerful, as it shifts positioning quietly ahead of visible shortages, creating price movement before headlines confirm tightness. And this is often when silver breaks resistance levels that had held for years, not due to enthusiasm, but due to risk avoidance. And once those technical levels break, algorithmic systems that have no understanding of fundamentals enter the market, amplifying moves purely based on momentum and volatility signals, turning what began as a defensive repositioning into an explosive rally that feeds on itself. And this is why the idea of silver moving sharply within hours is not hyperbole. Because in modern markets, hours are an eternity once forced flows begin, and the final accelerant in this sequence is psychological regime shift, because markets operate on shared assumptions until those assumptions fail. And for silver, the dominant assumption for over a decade has been that rallies fade. Breakouts fail, and suppression always returns. But once price moves decisively against that belief, sentiment flips rapidly, not gradually, because participants who were conditioned to sell strength suddenly hesitate, waiting for confirmation that never comes, while those who were sidelined rush to enter, fearing they will miss a move that feels structurally different. And this hesitation on the sell side, combined with urgency on the buy side, creates air pockets where price must jump to find liquidity, often overshooting because there is no anchored expectation of fair value once old ranges are abandoned. And this is why silver's most dramatic moves are often accompanied by disbelief rather than euphoria, with commentators insisting the move makes no sense even as it unfolds because sense is not the driver. Constraint is, and constraint does not care about narratives, only about balance sheets. And when balance sheets are under pressure, action is immediate, mechanical, and unforgiving. And this brings us to the most important realization of all, which is that silver does not need a catalyst. It needs a condition. And that condition is the convergence of leverage, tight supply, funding stress, and complacency, all of which appear to be present now, meaning that the system does not require new information to reprice silver, only a disturbance in an already unstable equilibrium. And once that disturbance occurs, the move is not debated. It is executed by machines, by risk desks, and by institutions that must act regardless of belief, turning what appears to be a sudden surge into the inevitable release of pressure that had been building silently for years. What happens? After the surge, who is trapped, who survives, and why silver exposes the system? When the silver surge finally arrives, whether it begins within hours, days, or a sudden overnight gap that leaves markets scrambling, the most important question will not be how high the price moves initially, but who is trapped on the wrong side when the move refuses to reverse, because history shows that the most dangerous phase of any repricing event is not the breakout itself, but the aftermath, when participants realize too late that the assumptions anchoring their strategies no longer apply, and silver is uniquely capable of creating this realization because it sits at the intersection of monetary distrust, industrial necessity, and financial leverage, meaning that once price breaks free from suppression ranges, it does not merely attract momentum traders. It forces a reckoning across portfolios that were built on the belief that silver volatility could be managed, capped, or neutralized indefinitely. And this is where late sellers, trapped shorts, and mispositioned hedges begin to dominate price action, not because they choose to, but because the system leaves them no alternative as margin requirements explode, funding lines tighten, and internal risk committees override trader discretion in favor of balance sheet survival, forcing exits at progressively worse prices, which is why silver's most powerful moves are often accompanied by increasing volatility rather than stabilization. Because volatility is the signal that control has been lost, and once control is lost, markets do not gently reprice. They overshoot, searching violently for a new equilibrium that reflects not just supply and demand, but fear, regret, and forced capitulation. In this phase, late participants are not investors. They are liquidity, and that distinction matters, because those who waited for confirmation, for analyst upgrades, for mainstream validation, or for healthy pullbacks discover that none arrive because pullbacks require willing sellers, And in a forced environment, sellers disappear, replaced by reluctant holders who refuse to part with assets that now feel structurally scarce, while buyers become increasingly aggressive, paying whatever price is required to secure exposure before the next repricing wave. And this imbalance transforms silver from a traded asset into a contested one, where price is no longer about valuation models, but about availability, particularly in physical markets, where premiums disconnect from futures prices, delivery timelines extend, and paper settlement becomes less attractive relative to tangible ownership, exposing the long-ignored divergence between financial silver and real silver. And this divergence is not academic. It is existential for participants who assume the two were interchangeable. As this unfolds, the narrative shifts rapidly, because narratives always follow price, never lead it. And suddenly, the same commentators who dismiss silver as obsolete begin explaining why it makes sense again, citing inflation, energy transition demand, monetary debasement, or geopolitical risk, explanations that were always true but ignored until price forced attention. And this sudden narrative pivot signals the transition from disbelief to rationalization, a classic marker of regime change, because when markets rationalize after the fact, it means positioning has already shifted, and the opportunity has moved from accumulation to risk management, leaving those who chased late vulnerable to sharp retracements driven not by fundamentals, but by profit-taking from early movers who understood the system before it broke. But the deeper consequence of a silver repricing is not measured in dollars per ounce. It is measured in what it reveals about the financial system itself, because silver rallies of this nature do not occur in isolation. They occur when trust in paper claims weakens, when leverage exceeds tolerance, and when central bank credibility is questioned. And once those questions surface, they do not remain confined to one asset class. They spread, infecting bonds, currencies, equities, and credit markets as participants reassess counterparty risk, settlement reliability, and the true meaning of liquidity. And this is why silver has historically acted as an early warning signal rather than a final destination, because it responds first to stress in the system's plumbing, exposing cracks that larger markets temporarily ignore due to scale, intervention, or inertia. And when silver moves violently, it is often because the system is already unstable, not because silver itself is extraordinary, but because it is sensitive. This sensitivity is precisely what makes silver so uncomfortable for policymakers and large institutions, because it resists narrative control, cannot be printed, cannot be conjured digitally, and exists outside the closed loop of balance sheets and central bank facilities, meaning that when silver prices accelerate despite intervention, it undermines the perception that authorities are in control. And perception is the true foundation of modern finance, because fiat systems function on confidence, not convertibility. And once confidence erodes, even subtly, markets demand higher risk premiums, higher yields, and greater compensation for holding paper promises, tightening financial conditions regardless of policy intent, which is why silver repricings often coincide with rising bond yields, dollar volatility, and stress in funding markets, creating a feedback loop where attempts to stabilize one area exacerbate pressure in another. For individual participants, the lesson of such a move is not simply own silver or trade volatility, but understand positioning, because wealth preservation in a leveraged system is less about predicting outcomes and more about avoiding forced behavior. And forced behavior is what destroys capital, because it removes choice, and choice is the only true edge investors possess. And this is why those who enter silver calmly, without leverage, without dependency on short-term liquidity, and without rigid price expectations, tend to fare better than those who chase moves using margin, options, or complex strategies that assume stable volatility. Because when volatility expands, those assumptions collapse, and strategies that appeared sophisticated become fragile. Ultimately, the silver surge is not a story about metal. It is a story about fragility disguised as stability, about systems that appear robust until they are tested, and about markets that function smoothly only as long as trust, liquidity, and leverage remain aligned. And once misalignment occurs, repricing is not a choice. It is a necessity. And silver, due to its size, structure, and history, is often where that necessity expresses itself first, violently, unapologetically, and without regard for fairness, expectations, or consensus, reminding participants that markets do not exist to validate beliefs, they exist to clear imbalances. And when imbalances grow large enough, clearing happens suddenly, not gradually. And this is why the most dangerous position in any silver surge is not being wrong about direction, but being wrong about timing under leverage. Because timing errors are survivable when capital is unencumbered, but lethal when margin, funding, and psychological pressure converge, forcing action at precisely the worst moment, turning what could have been a strategic allocation into a traumatic experience. And this is why understanding silver's role is ultimately about understanding the system, because silver does not break the system. It reveals where the system was already broken, quietly, invisibly, long before price began to move. If this silver surge unfolds as history suggests, it will not end with celebration or collapse, but with silence, as markets adjust, narratives reset, and attention shifts elsewhere, leaving behind a trail of lessons that most will ignore until the next cycle repeats. Because every cycle convinces participants that this time is different until it isn't, and silver remains one of the few assets that consistently exposes that illusion, not because it predicts the future, but because it responds honestly to present conditions that others prefer not to see. If this video helped you understand what's really happening beneath the surface, like the video and subscribe to the channel.